What if I told you that maybe the stock market isn't rising as much as it seems? Perhaps what's falling is the yardstick we use to measure everything: money. Because when you look at the market, you see the index rising, stocks hitting records, headlines talking about optimism, recovery, and the strength of the economy. But when you close the app and go live real life, the feeling is completely different. The supermarket is more expensive. Rent is a burden. Car insurance goes up. Home financing seems more distant. The credit card becomes a trap. And even though your salary has increased, it seems like you can buy less than you used to. So the question remains, if the economy is so strong, why do so many people feel poorer? This is where many people get confused. Sometimes the stock market isn't rising because the country has become richer. Sometimes it's rising because the money supply is getting weaker. If you want to understand economics without the fog of Wall Street, subscribe to the channel. Here I explain what's happening behind the numbers in a simple, direct, and straightforward way. The central idea of this video is simple. When everything is measured in dollars, and the dollar loses purchasing power, prices can rise even when the real value doesn't improve. The number on the screen may appear larger, but the real question is, bigger compared to what? Because if the ruler is shrinking, everything seems to grow. The stock market seems to be celebrating, but your life seems to be getting tighter. Rent hasn't gone down. Health insurance hasn't gotten cheaper. Car insurance hasn't improved. College tuition hasn't decreased. Gasoline is still a burden. The credit card bill seems increasingly dangerous. And the monthly grocery shopping, that simple trip to the supermarket, seems to take up an ever larger portion of your salary. So the average person looks at this and thinks, how can the stock market be rising? How can the economy be strong? How can they say inflation is under control and my life is clearly more expensive? This is the contradiction that confuses so many people. Because, for Wall Street, a rising market can seem like a sign of strength. But for a family trying to make ends meet, it might seem like a bad joke. And the reason is that there are two economies operating at the same time. There is an asset economy, where stocks, real estate, gold, Bitcoin, and large companies can increase in price. And then there's the real-life economy, where people need to pay for rent, food, energy, transportation, healthcare, school, debt, and interest. These two economies don't always move together. In fact, sometimes they drift apart, and that's where the discomfort begins. Because if you have many assets, you look at the screen and see your net worth increasing. But if you live primarily on a salary, you feel the cost of living rising faster than your income. For some people, inflation appears as an increase in the value of their assets. For others, it appears as a loss of purchasing power, and that difference changes everything. Because when the stock market goes up 20%, it can seem like wealth. But if the cost of living, buying a house, paying for healthcare, retiring, and maintaining the same standard of living also goes up, perhaps you're not getting any richer. Perhaps he's just running so as not to fall behind. And that's the part that a lot of people miss. The problem isn't just whether the market is going up. The problem is figuring out if it's rising faster than the money is losing value. Because if the stock market goes up, but your cost of living goes up too, the feeling isn't one of prosperity, the feeling is one of exhaustion. But now imagine that this ruler starts to shrink every year. It still looks like a ruler. It still has numbers written on it, everyone is still using it. But, little by little, each centimeter of it represents less than it once did. What happens? Everything starts to seem bigger. The table looks bigger, the wall looks bigger. The furniture looks bigger, but has the object changed? Or was it the ruler that shrunk? This is one of the simplest ways to understand what happens when we measure everything in a currency that loses purchasing power. When you say the stock market went up, the first question should be, by what measure? It went up in dollars. But if the dollar buys less food, less housing, less energy, less healthcare, and less of a future than it did before, then the nominal increase can be misleading. Nominal is the number that appears on the screen. What that number can actually buy is what's real, and that difference is enormous. A house can be worth $300,000 in 1 year and $450,000 a few years later. On paper, it looks like the owner got much richer, But if, during that same period, everything around you also went up, if another house went up, if insurance went up, if taxes went up, if maintenance went up, if the cost of living went up, perhaps that gain isn't as real as it seems. It may simply be a reflection of weaker currency. The same applies to stocks. If a stock price rises from $100 to $150, that sounds great. But if the money used to measure that price has lost purchasing power, some of that increase isn't real growth. It's just a price adjustment. It's like going up an escalator that's going down. You're moving forward, you're making an effort, you're seeing bigger numbers, but maybe you're just trying to stay in the same place. And that's uncomfortable because it changes the way we look at wealth. Your 401k might be larger in dollars, but the retirement income that money can buy may not have grown at the same rate. Perhaps your house is worth more now, but buying another house has become even more difficult. The stock market may be hitting record highs, but the average salary continues to lag behind rent, healthcare, education, car, insurance, and food. That's why a market upturn doesn't automatically mean prosperity. Sometimes it means that assets are trying to keep pace with the decline in money. And here's the most important part. When everything is measured with a shrinking currency, prices can rise, and yet life can still get worse. That's the illusion. You look at the number and think, I'm winning. But look at what that number buys and you realize, I'm being squeezed. That's why the central phrase of this video matters so much. Sometimes, the stock market isn't going up, the bar is going down. When people start to distrust idle money, they look for something that seems more difficult to devalue. And this doesn't just happen with big investors. Think of an average person. If she believes that the money in the bank will buy less in 2 years, what does she do? She starts looking at a house, at stocks, at gold, at Bitcoin, at land, at anything that seems more real than a currency losing value. Now imagine this happening on a gigantic scale. Funds, banks, companies, wealthy families, institutional investors, retirement funds, all looking at the same question: where do I put my money if money itself is losing value? This question changes market behavior, because, in a normal environment, idle money seems safe. But in an environment of persistent inflation, idle money starts to look risky. And when money becomes risk, assets become safe haven. Not because all of these assets are perfect. Not because stocks never fall. Not because real estate always goes up. Not because gold or Bitcoin don't have volatility. But because, in the investor's mind, owning something seems better than holding a currency that loses purchasing power every year. That's why markets can rise even when people are scared. This may seem contradictory, but it's not. Sometimes, the purchase of assets doesn't stem from optimism, he's fleeing. People aren't necessarily saying, the economy is wonderful. They might be saying, I don't want to be stuck with money if that money keeps melting away. And here's the uncomfortable detail. When many people think like that at the same time, asset prices go up, stocks rise, houses go up. Gold prices rise, Bitcoin rooms, collectibles go up. Anything that seems scarce starts to attract money. But that doesn't mean real life has improved. It simply means that more people are trying to protect value in a world where the unit of measurement seems unstable. And that's why so many people look at the market and feel angry. Because for those who own assets, this outflow may appear to be an appreciation in value. But for those who don't have it, it feels like exclusion. The house becomes more expensive. The funding opportunity becomes more distant, rent goes up, the stock market seems increasingly inaccessible, and the person who was trying to start building wealth feels like the ladder has been pulled up. This is one of the cruelest aspects of currency devaluation. It doesn't affect everyone in the same way. Those who have assets can at least partially protect themselves. Those who only have a salary and idle money feel the loss first in their pocket, then in their dreams, and then in their future. Therefore, when you see the stock market rising, don't automatically think, this is confidence. Sometimes, it's fear seeking shelter. Before you feel the obvious impact of your monthly grocery bill, rent, insurance, college tuition, or health insurance plan, the money may have already started moving to places where it's trying to protect itself. Wall Street usually reacts before Main Street. The financial market is looking ahead. The average family looks at the bill that arrived today. This difference creates a very strange feeling. While investors try to anticipate the central bank's next move, the next money printing, the next interest rate cut, the next stimulus package, or the next round of liquidity, the average person is trying to understand why the same shopping list costs so much more than it did before. And this creates two speeds. At first speed, the big money gets there first. He buys stocks, real estate, gold, Bitcoin, commodities, companies, land, anything that can preserve value if the currency continues to lose strength. In the second scenario, the worker waits for their salary to be adjusted. And the salary almost always arrives late. The rent goes up first, the insurance premium goes up first, the food goes up first, the car payment goes up first. Home financing becomes more expensive sooner. The card charges higher interest rates upfront. When income goes up, it goes up again later. And often it goes up less. That's why so many people feel like they're always playing catch-up. Inflation doesn't affect everything at once. It spreads. First, it appears in asset prices. Then, it appears in the company's costs. Then it appears in consumer prices. Then, it comes up in salary negotiations. And when payday finally arrives, the person has already spent months or years losing purchasing power. This is one of the reasons why the stock market may seem strong while real life seems weak. The market is trying to position itself for the money of the future. The family is trying to survive on the money from the gift, and that difference is brutal. Because if you already have assets, you might see some of that inflation as an increase in your net worth. But if you're trying to buy your first home, build your savings, invest for the first time, or retire securely, you feel inflation as a door closing. The same phenomenon that causes the wealth of some to grow can make the beginning of the journey much more difficult for others. That's why a stock market rally doesn't console those who are paying higher rent. It's no comforting to see your health insurance premiums go up. It's no comfort to look at the 401k and think, the number has grown, but will that still be enough to fund my retirement? It's no comfort to those who have money sitting idle in the bank and realize that, year after year, it buys less and less. And here's the most annoying part. When asset prices rise before wages, inequality increases without the need for any official announcement. Those who own assets are better protected. Those who depend solely on their salary are exposed. And those who are in debt experience two pains at the same time. The cost of living rises, and so does the cost of the debt. So, when someone says the stock market is going up, the right question isn't just how much has it gone up. The real question is, for whom is this good news? Because a rising stock market can mean opportunity for those who were already invested. But it could mean a greater distance for those who are still trying to get in. And that's the central point. Wall Street can celebrate rising prices. But Main Street needs to pay those prices. Sometimes, rising stock prices are not a sign of good performance. Sometimes, they are a sign of fear. It sounds strange, but think about it. If the market believes that the economy is weak, that public debt is heavy, that the government is unable to cut spending, and that at some point the central bank will need to inject liquidity again, what do investors do? They try to anticipate. They are not waiting for new money to appear, they buy it beforehand. Because, in the market's mindset, if things get bad enough, someone will try to save the system. It could be through interest rate cuts, it can be with stimulation. It could be through the purchase of assets. It could be through credit expansion. It could be with more money circulating. And when more money enters the system, that money has to go somewhere. Often, he goes for actions, go to real estate. It's going to be gold, go for Bitcoin. It goes towards scarce assets, so the stock market might rise not because companies are selling much more, hiring much more, or because families' lives have improved. It may go up because the market is betting that, if the situation gets tight, the response will be more liquidity. And more liquidity tends to raise asset prices. But there is a huge difference between raising prices and improving real life. It's one thing for an action to pop up on the screen. Another thing entirely is for the worker to be able to buy a house, pay for health care, get out of debt, build up savings, and retire comfortably. And this is where many people get lost, because the market can look at monetary inflation and see an opportunity. But the average family looks at the same inflation and sees a loss. For large investors, more money in the system can mean rising asset prices. For those living on a salary, it can mean more expensive food, higher rent, heavier insurance, and more suffocating credit. So when someone says the stock market is booming, that doesn't answer the most important question. The most important question is this increase stemming from real growth or currency devaluation? Because if companies are becoming more productive, selling more, innovating more, and generating more real profit, that's one thing. But if prices are rising because the money used to measure those prices is losing value, that's something entirely different. And that difference matters, because you can open your investment app and see your larger portfolio. That if the house you wanted to buy has become even more distant, if your health insurance has gone up, if your car has become unaffordable, if your children's college tuition has become more expensive, and if retirement requires much more money than before, you need to ask yourself, did I really get rich, or do I simply have more dollars in a world where each dollar buys less? Before we continue, comment on one thing. Do you feel that the official numbers match your real life, or do you feel that life is much more expensive than they admit? And if this explanation is helping you understand the economy in a simpler way, leave a like so this video reaches more people. Now, here's the uncomfortable part. The market doesn't need to believe that everything is fine in order to go up. Sometimes, he just needs to believe that when things get bad, someone will print money, cut interest rates, or bail out the system. This creates a dangerous logic. Bad news can turn into good news for assets. A weak economy may increase expectations for stimulus. High debt levels can increase expectations of new money. A liquidity crisis can lead to baits on bailouts. And so the market rises not because everything is healthy, but because it expects the currency to weaken in order to keep the system functioning. This is the point that many people fail to see. The stock market can rise during a period of monetary impoverishment. It could break nominal records while families lose purchasing power. She may seem strong while the foundation that supports real life becomes more fragile. Therefore, a market maxim needs to be questioned. Not all high levels of success mean prosperity. Some price increases are simply a reflection of money that is losing value. And if you measure everything with a weakened currency, even a fragile system can appear larger on the screen. Because all this talk about the stock market, the dollar, inflation, liquidity, interest rates, and assets can seem distant until you realize where it truly applies. She appears on your 401k. It appears in your retirement. It appears in your emergency fund. It appears on your credit card statement. It appears on your home financing. It shows up in the price of insurance, gasoline, health insurance, your children's college tuition, and the food you buy every week. This is the silent risk. It's not just the market crashing. Many people are afraid to open the app and see their portfolio in the red. But there's a more subtle, and in many cases more dangerous, risk. Opening the app, seeing the number going up, and still losing purchasing power. Because if your 401k is growing in dollars, but the retirement you need to fund has become much more expensive, you need to look beyond the number. If your emergency fund remains the same, but 6 months of expenses now cost significantly more than they did before, your reserve has shrunk in real terms. If you have money sitting idle thinking it's safe, but that money buys less each year, perhaps the security is only an illusion. And if you have expensive debt, the situation can be even worse. Because inflation and high interest rates can crush both sides of your life at the same time. On one hand, the cost of living is rising. On the other hand, the cost of carrying debt also increases. Credit card bills are getting heavier, personal loans are getting more expensive. Car financing is becoming more difficult. Higher mortgage rates make homeownership more distant, and for many people, this creates a feeling of being trapped. You work, you pay bills. You try to save, you try to invest, but the finish line is moving. The house that seemed within reach is now further away. The retirement that seemed planned requires more money. The salary that once seemed sufficient is no longer. And the standard of living that their parents may have managed to build seems increasingly difficult to replicate. This is the emotional side of inflation that the graphs don't show. Inflation doesn't take everything away at once. She takes it off little by little. It reduces choices. She postpones plans. She turns comfort into tightness. It makes people who have done everything right wonder why they still feel like they're falling behind. And that's why it functions like an invisible tax. No one needs to vote for a new tax for you to lose purchasing power. The currency simply needs to buy less. All it takes is for the cost of living to rise faster than your income. If your savings yield less than the actual inflation rate, you'll feel it. And it's important to be clear here. This doesn't mean you should panic. It doesn't mean selling everything. It doesn't mean buying any asset just because someone on the internet said it will protect you. The right question isn't, what is the magic asset? The right question is, what in my financial plan depends on a currency maintaining its purchasing power? How much of my future is tied up in idle money? How much of my life depends on cheap credit? How much of my retirement income depends on nominal returns that may not be real returns? How much of my sense of security comes from numbers that seem large, but are buying less and less? Those are better questions, because in a world where the bar is shrinking, protecting the future isn't just about making more dollars. It's about preserving what those dollars can buy. This could mean that the currency used to measure that market is losing its value. This could mean that investors are fleeing from idle money. This could mean that the market expects more liquidity, more stimulus, more interest rate cuts, or further currency devaluation in the future. And that completely changes the interpretation. Because if the stock market goes up, but food goes up too, rent goes up too, insurance goes up too, healthcare goes up too, college tuition goes up too, and retirement becomes more expensive, then the question isn't just, how much did I earn? The question is, how much more can I afford to buy? That's the difference between looking richer and being more protected. That is the difference between nominal growth and real growth. That's the difference between looking at the app and looking at life. And perhaps that is the greatest financial illusion of our time. People are being trained to celebrate larger numbers without questioning whether those numbers still mean the same thing. A larger portfolio doesn't solve everything if the cost of the future rises faster. A more expensive house doesn't solve everything if buying another house has become impossible. A record-breaking stock market doesn't solve everything if the average family is more indebted, more insecure, and further from retirement. The point is not to live in fear, the point is to see clearly. Because, in a system where currency loses purchasing power over time, protecting assets is not just about seeking returns. It's about understanding what real return is. It's about understanding that idle money carries risk. It's about understanding that assets also carry risk. It's about understanding that not all high levels of success equate to prosperity. And above all, it's about understanding that the ruler may be shrinking while everyone else is celebrating that the numbers have gotten bigger. So comment below, do you think the stock market is actually going up? Or do you think money is worth less? If this video helped you understand this difference in a simpler way, leave a like. And watch the video that's playing on the screen now, because it explains the next piece of this puzzle. How inflation can destroy purchasing power even when the numbers look positive. Sometimes, the market isn't going to the moon. Sometimes, it's the money that's sinking.